All right, today we are diving headfirst into the high-stakes, super fast-paced world of property auctions. This is a world where your choice of financing, well, it can literally be the difference between a massive win and a truly catastrophic loss. So let's just jump right into a real-world scenario to see exactly how this plays out. So, picture this. The auctioneer's hammer falls. Your heart is pounding. You've done it. You've just won your dream investment property. What a feeling. But now the reality kicks in. The clock is officially ticking. You've got just 28 days. That's it, to find the rest of the money. So the big question is, can you actually do it?
Okay, let's break this whole thing down. We're going to follow a really common auction situation. A property that's got loads of potential, but it's looking a bit tired. It needs some vision for sure, and it needs a lot of speed to get the deal over the line. So here are the numbers. You've just won a 3-bed semi for £300,000. Brilliant. You immediately pay the 10% deposit. That's £30,000 right there, straight out of your 60 grand cash pot. Now here's the kicker. You are legally bound to complete this purchase in 28 days. If you fail, you don't just lose the house, you lose that entire £30,000 deposit. It's just gone.
So you've got this £240,000 gap to fill, and you're officially standing at a crossroads. There are two very, very different paths you can take from this point. One leads to a great success story, and the other, well, it leads to a very costly failure. Let's explore that first path, shall we?
Right. This is the path that most people think of first. It feels safe, It feels familiar. But as we're about to see, when you're in a time crunch like an auction deal, this path can be an absolute recipe for disaster.
So on day one, you send your application to a high street bank. You get an agreement in principle, and you're feeling pretty confident. But then it hits the underwriter's desk. And by day 7, the questions start trickling in. Each email back and forth adds another day or two of delay. Then, on day 19, the surveyor's report lands, and it flags the tired kitchen, the dated bathroom, recommending the lender hold back some of the money. This is what's called a mortgage retention, and it's a complete disaster when you need every single penny to complete the purchase. You see, a standard mortgage, it can take anywhere from 2 weeks to, honestly, 8 weeks or more to arrange. And as those precious days tick by, your solicitors start getting nervous, the seller's side starts getting pushy, and you're just another file in a very, very tall pile on someone's desk. And then day 28 arrives. No funds. You've missed the deadline. You've failed.
And the result? It's catastrophic. You've breached the contract, and you lose your entire £30,000 deposit. All that work, all that excitement, that dream, it's just vanished. And why? Simply because the tool you chose was way too slow for the job.
But what if there was another way? Let's hit the rewind button. Let's go all the way back to day 1, and this time, let's take that second path. This time, the approach is going to be completely different. This time, you call a specialist bridging broker, and the conversation is night and day. They're not obsessed with your payslips or your employment history. See, bridging finance is asset-based. They really only care about 2 things. What is the property worth? And, this is the big one, what is your plan to pay back the loan? We call that your exit strategy.
And the difference in speed is, well, it's just remarkable. A valuer is booked on day 2. By day 15, the official binding offer is on the table. And the money is sitting with your solicitor by day 20, a full 8 days before the deadline. The property is yours. Deal done. That is the power of using the right tool for the right job.
Now, of course, this kind of speed, it comes at a price. Bridging rates are higher, they're quoted monthly, and you're going to have arrangement fees and other professional fees on top. So yeah, it's definitely more expensive in the short term, but you have to think of it as the cost of actually securing the asset. Without it, you'd have lost 30 grand anyway.
Okay, but securing the property, that's just part 1. Remember, a bridging loan is exactly that. It's a bridge. Now it's time to execute your exit plan and get to the other side.
So you get the keys, and you get to work immediately. You spend that £30,000 you had left on a cosmetic facelift, a shiny new kitchen, a modern bathroom, a fresh coat of paint throughout. You completely transform the place.
A few months later, you get it revalued. And thanks to all your hard work, the surveyor now values the property at £380,000. It's no longer that tired, risky property. It's now a prime income-generating asset. Now, with this much higher valuation in hand, you can go back to a traditional lender for a long-term buy-to-let mortgage. And now they are more than happy to lend you 75% of the new value. That gives you a mortgage of £285,000.
And this is the masterstroke of the whole strategy. That new mortgage for 285 grand, it pays off the entire £240,000 bridging loan, and it also repays the 30 grand you spent on the refurbishment. You're now in control of a valuable asset with a standard mortgage on it, and you've successfully navigated that time-critical purchase.
So, for an auction deal, it's pretty clear the bridging loan is the hands-down winner. I mean, it's not even a fair fight. But before you get all excited and rush off to the next auction, there is something absolutely critical that you need to understand.
Bridging finance is an incredibly powerful tool. It's true. But it is also a high-risk one, and this is not a strategy you should ever take lightly.
Look, the single biggest risk is your exit plan failing. What if the refurb takes too long, or the final valuation comes in lower than you hoped? That high monthly interest will just keep racking up, and if you can't repay that loan at the end of the term, you could lose the property. It's also really important to know that most investment bridging is unregulated. That means it doesn't have the same consumer protections as a standard mortgage. You absolutely 100% must have a rock-solid exit plan, and a backup plan for that too.
Maybe the best way to think about the difference is like this. A traditional mortgage is a marathon runner. It's stable, it's steady, and it's lower cost for the long haul. A bridging loan, on the other hand, is a sprinter. It's built for explosive, short-term speed to seize an opportunity right now. It's more expensive, and it definitely carries higher risk, but it's designed to win a very specific, very short race.
Knowing when to run the sprint and when to settle in for the marathon, that's what separates the really successful investors from everyone else. So the final question is for you. Knowing what you know now about the risks and the rewards, which tool are you going to reach for on your next property deal?